Did you know that the anticipated global inflation rate for 2023 stands at 6.9%? Given that we are only halfway through the year, there is a possibility that the rate may continue to increase or decrease by the year's end. Despite the recent slowdown in inflation, we should not become complacent, as this attitude may unwittingly make us vulnerable to lifestyle creeps, impacting our financial well-being. By staying until the end of this video, you'll gain a better understanding of lifestyle creeps, inflation, and how to navigate your way around them to avoid falling victim to their trap. If you suspect you might already be affected, this might be your best chance to break free and take control of your financial future. In the biggest economies, inflation is experiencing a slowdown due to reduced economic growth and weaker demand, which is limiting the increase in prices. Forecasts for inflation in the U.S. and the Eurozone have remained mostly steady compared to the previous quarter, as the prices of manufactured goods and commodities ease, helping to control inflation. On the other hand, inflation forecasts for emerging markets have been revised downwards due to improvements in supply chains and lower commodity prices, which are relieving inflationary pressures. In times of difficulty, we often seek to improve our financial situation by working harder and increasing our income. Sometimes, our growing income can become a challenge to manage, leading us to unknowingly succumb to the allure of the hedonic treadmill known as lifestyle creeps. Don't worry, the Stealth Wealth Society is here to offer a comprehensive understanding of financial management. To stay updated with our latest financial videos and gain access to valuable resources, be sure to click the subscribe button. Moreover, we have an all-inclusive personal finance course priced at just $97, carefully designed to help you master the art of building wealth discreetly. Consider it an investment into your financial health. As an enticing offer, you can also receive a complimentary copy of our personal finance ebook by accessing the link provided in the description. Check it out. While it may seem logical that a higher salary would lead to more money in our bank accounts, this is not always the case. In reality, lifestyle creep can erode the potential benefits of a salary increase, leaving us with less disposable income. Lifestyle creep, also known as lifestyle inflation, occurs when we start overspending once our income rises. For instance, if you secure a new job with a $20,000 annual increase in take-home pay, but decide to purchase a non-essential car worth $30,000, you may end up with more debt than before the pay raise. The insidious nature of lifestyle creep is that it can unfold gradually over the years, making it challenging to detect unless you closely monitor your budget. Recognizing lifestyle creep, understanding its impact on your life, and learning how to avoid it are crucial for maintaining financial stability. What is lifestyle creep? Lifestyle creep refers to the tendency of increasing one's spending when experiencing a raise in income, rather than saving the additional earnings. It can also occur when someone pays off a loan but chooses to use the extra money for spending instead of directing it towards savings. When lifestyle inflation takes hold, things that were once considered non-essential, such as entertainment subscriptions and dining out, now become perceived as necessary after an increase in income. Lifestyle creep doesn't solely involve material purchases, it can also encompass spending on new experiences. For instance, consider a couple who recently paid off their mortgage. Instead of channeling the extra cash flow they now have, previously used for mortgage payments, into a savings account, they decide to allocate the entire amount to fund their desire for more travel. Robin Aiken, principal at Homerichberg Wealth Management, provides this example to illustrate how lifestyle creep can manifest in prioritizing immediate experiences over saving for the future. Lifestyle creep signs. Stagnant savings. Your savings remain stagnant despite salary raises and bonuses. If you've been receiving increases in income for several years but haven't seen any significant growth in your savings, it's a clear indication that you might be spending all the extra money you earn. Neglecting to prioritize saving can have serious consequences for your overall financial well-being. Increased spending. If you find yourself spending more money in various areas because you feel like you can afford it, lifestyle creep could be at play. This might manifest in more frequent dining out, purchasing more expensive gifts, opting for pricier vacations, and subscribing to multiple new memberships or services. Lack of budgeting. Lifestyle creep is more likely to take hold when you have no clear idea of where your money is going. Without a budget in place, it becomes easy to overspend without being aware of it. Knowing how much you allocate towards additional expenses each month is crucial to prevent uncontrolled spending. Lack of financial control. If checking your bank account balance causes stress due to excessive spending, or if you constantly worry about diminishing savings or growing credit card debt, these feelings may be signaling that your lifestyle is surpassing your income capacity. It's essential to pay attention to these warning signs and take corrective measures. Over-reliance on credit. If you find yourself increasingly relying on credit cards or loans to sustain your lifestyle, it could be a red flag for lifestyle creep. Piling up debt to maintain an inflated standard of living can lead to financial instability in the long run. Minimal long-term savings. When lifestyle inflation takes precedence, saving for the future might take a back seat. If you are neglecting to contribute to your retirement accounts or other long-term savings goals, it's time to reevaluate your spending habits. Ignoring financial goals. If you had set financial goals but haven't made any progress towards achieving them due to increased spending and lifestyle inflation, it's crucial to reassess your priorities and align your actions with your aspirations. Recognizing these signs of lifestyle creep and taking proactive steps to address them can significantly improve your financial health and ensure a more secure future. Impact of lifestyle inflation on financial goals. Lifestyle inflation can significantly impact an individual's long-term financial aspirations. While indulging in small luxuries or impulsive purchases may seem harmless, these expenses can quickly accumulate and jeopardize one's ability to save for retirement, pay off debt, or invest in other financial objectives. Moreover, succumbing to lifestyle inflation may create a dependency on a higher income, making it challenging to adapt to any potential decrease in earnings due to unforeseen circumstances like job loss or economic downturn. Nevertheless, it remains crucial to be mindful of lifestyle inflation and its potential consequences. One effective way to combat it is by establishing a budget and adhering to it. Setting clear spending limits and prioritizing financial goals enable individuals to avoid overspending and maintain a sustainable lifestyle that aligns with their long-term aspirations. Picture yourself in your mid-30s, and you've just been promoted at work, resulting in a substantial salary increase. Filled with excitement over your higher income, you make a series of lifestyle upgrades. You decide to trade in your current car for a more expensive model, upgrade to a larger house in an upscale neighborhood, and indulge in dining at fancy restaurants more often. Additionally, you begin splurging on expensive gadgets and treating yourself to more frequent vacations. Now let's break down these costs. Luxury car. The monthly payment for an extravagant car could range from $600 to $700 or even more, depending on the car's model and financing terms. Over a span of 5 years, this would sum up to $36,000. Bigger house. Relocating to a larger, more upscale house can lead to higher rent or mortgage payments, increased maintenance costs, and greater utility bills. These expenditures could easily total an extra $700 to $1,000 or more per month, amounting to $36,000 to $40,000 over a period of 5 years. Dining out and gadgets. Frequenting fancy restaurants, purchasing expensive gadgets, and taking more vacations could add up to several $1,000s each month, which would quickly accumulate to tens of thousands of dollars over 5 years. When you consider these expenses over the long term, it becomes evident how lifestyle inflation can significantly erode your wealth. Instead of using the additional income to save and invest, you end up spending it to maintain a higher standard of living. Consequently, this may leave you with little to no savings and limited financial security for the future. On the other hand, had you avoided lifestyle inflation and continued to live within your means, you could have utilized the surplus income to save and invest, potentially growing your wealth over time through compound interest and capital gains. If you still want to know more about lifestyle creeps, we have some hacks that might be helpful to you. Watch this video about how to avoid lifestyle creep. 8 ways to combat lifestyle creep in this link. See you in this video.